Good morning, everyone. It is 6 a.m., half an hour before the market's going to open on July 1st, Monday, July 1st. We're about to kick off what is probably going to be an extremely quiet week. So it is the week of July 4th. It's always a very quiet trading week, especially when July 4th falls in the middle of the week. What is going to happen this week is July 4th is on Thursday. So Thursday is going to be completely closed. And then Wednesday, this little asterisk means that on Wednesday, we're going to close early. So 1 p.m. Eastern, which is 10 a.m. Pacific. That means we only have not even 4 hours, 3.5 hours of trading on Wednesday. So Wednesday is going to be super quiet. Thursday is not going to trade at all. And then Friday, basically every institutional manager that can possibly take time off is going to take time off. It's going to be a little interesting because we have some pretty important reports coming out on Friday, and there could be the potential for market manipulation. But my recommendation is if the institution guys, the normal institution guys are out, then we don't trade either, because then you are trading against algorithms, you're trading against retail traders, which is not that big a deal, but you're also trading against a few sharks that are going to salivate at this opportunity to trade against retail traders and try to manipulate markets. So Friday, we're not going to trade at all unless it's a defined exit of one of our positions. We're not going to try to get into any new positions at all unless it is a very programmatic and defined entry into a position, but most likely we won't even do that. So Friday is mostly for exits. The volume is going to be super low. And unless we have reasonable volume or decent volume in an individual stock, I wouldn't trade it at all this week. So we've been looking at volume versus the average volume on the S&P 500. And you can see there's only been a couple of days where the volume has surpassed or even come close to the moving average over here. And those are generally days that we said, oh, it's caused by algorithms because there's news or some sort of market event, or it was very quiet because of like the June 19th holiday. And there was potential for that volatility and for algorithms to come in place. Well, we don't really have that necessarily in individual stocks, so we don't normally look at this. But when I say this week it's going to be really quiet, just say you wanted to trade Google. Well, if it looks like this day on Google or this day on Google where it's maybe 2/3 of the moving average on volume, then don't trade it. This day was okay. You see, hey, volume's coming in, and maybe a couple hours, 3-4 hours into the trading session, we're already beyond the moving average. You know something is going on in Google this day, so it was okay to buy. And if you did that, you can see that it went up quite a bit. But about on this day, you might have been okay trading Google on these days, but it's risky this week. It is really, really risky. So I would personally, I'm not going to trade unless a stock is exhibiting strong volume relative to its moving average this week in particular. Really, really important. So just treat it like a very quiet week. That's basically what every institutional trader is going to be doing if they're not already on vacation. So well, for the most part, we're just going to sit and watch or do something else, go on vacation ourselves. So just a heads up, while we look at everything, nothing's going to be really meaningful this week. Oh, if we look at our S&P 500, it looks like it's up a little bit, but we would need to know if that's meaningful. So let's take a look at the futures first. So S&P 500 is up about 25 basis points. The NASDAQ up about 30 basis points. And then the Dow up about 10 basis points. This is the most normal I've seen this in a couple of weeks. this is the normal relationship. You've got the S&P in between the NASDAQ and the Dow. We've seen that for most days the past couple of weeks, but the difference in the amount that each one is up is finally normal. It's not normal for us to have Dow way down and then the NASDAQ way up, or for one to be up 70 basis points, the other to only be up 10 basis points. Right now, this difference between the Dow and the NASDAQ is only about 20 basis points, a little less than 20 basis points. So this is a lot more normal. This is the first time we've seen this normality in a very long time. None of these are non-random. NASDAQ is pushing the border of non-random, but still random. And we're not going to get too excited about that. This week in particular, unless there's some major thing that happens, most likely we are chopping sideways. We could drift upwards, but it'll probably get undone. So most likely we're just going to watch the markets chop back and forth. And that's sort of what the markets are telling us. If we look at the S&P sideways, if we look at the RSP sideways, if we look at the QQQ sideways, if we look at the equal weighted QQQ sideways. So are we going to break this wedge this week? Probably not, unless it's on very weak volume, in which case it's very easy to bring it back in line. If we look at our momentum levels, what we discovered over the weekly market review is that it started to normalize a little bit. I was a little bit surprised when I saw it, but it is what it is. We need to modify our viewpoint based on what the market is doing, not stick to our viewpoint and just hope and pray and try to force the market to match our viewpoint. That's never going to work because we have zero control over the overall markets. So when we look at the market momentum, what we saw is that this started to normalize. We was down at 37, 38. Now it's at 44. And the 200 MA is no longer at 50.7 something. It's 54.28. So this is starting to look healthier. It's still not excellent, but it's starting to look a lot healthier than it was before. And if we looked at our index performance, 47.68, that's looking healthier, not excellent, but healthier. And then Russell, same thing. And then NASDAQ is looking very healthy on that top level. What the difference between this NASDAQ and the S&P 500 is still showing us that those FANG stocks, those very large cap stocks, are still playing a major effect in the market, but it looks like those have calmed down a little bit. And when we see what happened on Friday in the SMH, you can see that, oh, well, the last week we've just been chopping sideways. And the NVIDIA chopping sideways, and XLK chopping sideways. So this is matching up with those overall indices, and that's allowing us to defragment. Remember, fragmentation or disparities and discrepancies in the markets are corrected by either chopping sideways or pulling back. And we had reversion to the means in all of these, everything that we mentioned, either to EMA 8 or the EMA 20, and then chopping sideways. So we got a little bit of both in everything, and that's allowing us to defragment. It's starting to look a lot more positive. It doesn't mean we're not at risk of pulling back, but at least right now we are in a very neutral place and we're not biased one way or the other. It's just looking like, oh, this pressure that we had up here looks like it may be, well, for sure, some of it has been relieved by that pullback. But when it pulled back, we were saying that it still looked like we might get to the MA50. But now that we've chopped sideways for the rest of the week, now it's looking a lot better. It's looking a lot better than it was before. So that pressure is slowly being relieved out of the markets. And given that we're expecting a very quiet week this week, that's going to give us the opportunity to chop sideways even longer. And after a couple of weeks of chopping sideways, that could potentially set us up for moving higher. I'm not saying that we are. I don't have a bias at this point. It's just neutral. So if I look over here, chop sideways for a week, 2 weeks, technically a pull back to the EMA 20, but actually what happened was the EMA 20 rose up to touch. I think we drew a box on the SPY. Let's do it on over there. Yeah. Did you see that? So technically, if we have this box, or if I had just stopped this box right here, okay, or I guess right here, then what we would see is that we chopped sideways for 2 to 3 weeks. And this sideways movement was met by this rising EMA 20. And that allowed the market enough relief so that it could continue moving higher. It could have gone down from that point. It's about 50-50. We just have to see the tests. It tested down here and it bounced off. It tested up here and it broke through. And then it continued upwards after a little bit more chopping at this new level. So that's starting to look like what we have right here. If we draw a box right here, okay, you can see that where we closed on Friday is not that much higher than this first bar over here. It matches the high of the second bar right here, matches the high or the close of the third bar right here, and it matches pretty much all of these bars right here. We only had this that defined the top of the box, and we touched that top of the box on the high. So this is a very defined range, and this is a sideways movement over more than 2 weeks. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 1, 2, 3. So 2.5 weeks we've been chopping sideways here, and that is giving us the opportunity to relieve that pressure. So far, the EMA 8 has risen to touch it. So it was somewhat inaccurate to say that this was a reversion to the mean. It is a reversion to the mean, but did the price come down to touch the moving average, or did the moving average rise to touch the price? And the answer is a little bit of both, because we did move a bit higher and then come back down to the moving average, but also the moving average started from way down here and met us halfway. So both of them came and converged together to give us the current chopping sideways level. And if we keep on doing this for another week, which is highly likely because of the holiday, then it is very likely that this EMA 20 will come up and touch those prices as well, just like we had in this situation right here, which is a little bit of, hey, we pulled back to the EMA 20 and the EMA 20 rose up to. So we're going to have, it looks like we're going to have a very similar situation right here, and that does give us the potential to move higher. And more importantly is that in this SMH, this chopping sideways has allowed us to normalize a little bit and relieve the disparity between the FANG stocks and the rest of the market. Not completely. Obviously, the FANG stocks, large cap, they're still carrying the market for the most part. But what we saw over the weekly market review and on Friday is that we're starting to get breadth. It's not just SMH anymore. It's SMH plus XLK. We started to include XLC, and we started to include consumer discretionary. Consumer discretionary did pretty well this past week, got pulled down a little bit by Nike on Friday, but it looks like this morning, yeah, we're bouncing right back up. So we're starting to get that breadth in the markets. It's starting to look a lot healthier. Most likely we are going to continue to chop sideways, but we do have the potential to move higher from here. So very neutral at the moment, but it looks like we could get start leaning bullish, whereas all last week and the week before was like, hey, we're neutral, but we're probably going to lean bearish. So just that's a major change in the viewpoint of the markets right now. Let's take a look at our economic reports this week, because there are some pretty major ones. Actually, before I do that, let's take a look at TLT. bonds. Bonds came way down. Whoa. Okay. So way down on Friday. And look at this huge gap down into today. So far, wait, yeah, pre-market. Today, huge gap down. This is what we've been waiting for in our TLT trade. So at the market, we're going to watch this one carefully. So since we're going to expect most of the rest of the market to be dead, we're going to look over here and just watch and see at the open, does this continue to move downwards and finally level off somewhere, or does it rebound? In any case, I'd give it at least half an hour before we make any decisions, potentially closing those example trades that we have in over here. You can see that after Friday, we're basically across the three phases of entry. We were basically break even, just a tiny bit under. But with this huge gap down, we'll definitely be on all three positions, we'll be in profit. So looks like a potentially good time to close. I think we can get lower, but if the market gives you this type of movement, you should probably take it, because it will recover and bounce around, and then July 31st will come around and we'll probably be somewhere down here. But you've already made the majority of the movement, so is it worth waiting another month and suffering time decay while you're waiting for it to go a little bit further down? The answer is most likely not. But intraday today, you may get a little bit more. So this is something that if you're available to watch during the day, then I would watch it during the day. Otherwise, just set your order and just get out of those positions. That is definitely moving and looking like a more resolved picture. So I did not expect this. So there must have been some sort of news over the weekend that caused this. So I'm not too sure what happened here either. Gap down right here. There's some, actually, you know what it was? It's probably the presidential debate. It was probably Trump-Biden presidential debate. And not to get into the politics of it, but the news does move the markets, especially bond markets. And there was a very large discrepancy between the performance of the two candidates, and the bond market is interpreting that as rates higher for longer. So that's all I'll say about that. I won't get into the politics of it. So this is movement because the market is waking up a little bit to the fact that, well, for sure, July does not look like a rate cut. So if we look at this market watch, that was just from 10.3% down to 8.8%. Maybe when we open today or by the time we close that, this 8.8 will shrink even lower. But what we're expecting is 0%. If this is the movement just from 1.5 percentage points, or no, let's not include today because maybe that number is updated for the pre-market, which probably isn't. So that 1.5% was this big bar right here. So this movement is a similar size, maybe a little bit lower. So we're probably talking another 1% lower, which would bring us to 7.8%. And we're expecting that 7.8% to go to 0. So depending on how quickly that collapses, the TLT prices could potentially even go lower than this here, maybe all the way to the bottom of this channel if we extend it out by the time we hit the end of this month. I'm not going to call it right now, but again, my preference to do is take profits right here, see what happens, maybe watch it come down to this level, because it's not going to go straight down. It'll probably bounce at some point. And if it does bounce and it bounce back up to the MA50 or to the top of the channel, that's another opportunity for the trade because we've got a whole month to go. So this is looking like something I want to pay attention to, because this is like the juiciest opportunity right now, given that the markets are just going sideways and flat. No, not really difficult to find stocks that are going to give you a high probability opportunity to either make money to the upside or downside. But TLT is like, this is this is juicy. So this is probably going to get the majority of my focus over the next 1 to 2 weeks. So let's finish with our economic reports, though. We've got Powell speaking tomorrow. I just don't know how much that is going to affect things, but it could affect those bond expectations depending on what he says. So this is something to pay attention to. TLT is really looking juicy now. And we also have minutes, right? FOMC minutes. Yeah, we have FOMC minutes on Wednesday. That could also affect bonds, but personally, I'm not going to be surprised by anything that they say in there because we basically know their position. Hey, maybe one more rate cut this year, and we need to see more data. But once we see it in hard writing and know for sure, that removes uncertainty from the markets. There are some people who are still obviously still holding out hope that there is cut because this is non-zero and it's somewhat significantly above 10% is not a great percentage point, but it's kind of far from zero. If you said under sub 5%, then that's a really low chance. But 10%, you're still kind of holding out some sort of hope. So these minutes, you remove some of that uncertainty, then this can pop a little bit lower even on Wednesday. Thursday is closed. And then we have the employment situation. This report comes out once a month, first Friday of every month, and it's always very closely watched, even when the Fed isn't involved in the markets. So the employment situation, because the Fed is in the markets and they have the dual mandate of the unemployment rate and the interest rates, this is going to be pretty important because one of the speakers last week mentioned, hey, it looks like we've made enough progress on the inflation front that we can start shifting some of that attention now to the unemployment front and start balancing out our attention or our focus between our two mandates, because it's always been inflation for a really long time right now. So if that's the case, then this report is going to become that much more important. So we'll watch out for that on Friday. Looks like TLT is going to be the focus because I'm not expecting any sort of action in stocks. So we'll watch that very carefully and just keep an eye out for movement in bonds. That's it for this morning. We're 6 minutes away from the market open. Have a wonderful rest of your day, and I'll see you in the post-market session.